Welcome, everyone. Today, we're diving deep into the Sarbanes-Oxley Act, SOX, from 2002. We'll be looking at what it is, why it happened, and really what it means for auditors and companies.
That's right. It's a huge piece of legislation. Think back to the early 2000s Enron, WorldCom.
Right.
Big scandals shaking investor confidence.
Hey, total chaos.
Exactly. So SOX was Congress's answer. The main goal was, to make financial reports from public companies more accurate, more reliable, rebuild that trust.
Okay, so let's start with Title I. That created the PCAOB, right? The Public Company Accounting Oversight Board. What's their role?
Yeah, the PCAOB. Think of them as the new sheriff in town for auditors of public companies. It's a 5-member board overseen by the SEC.
And interestingly, only 2 of them can be CPAs.
Correct. To bring in different viewpoints, their job basically is registering audit firms, setting the rules, the auditing standards, inspecting the firms, and, well, disciplining them if they step out of line.
So if you want to audit a public company, an SEC issuer, you have to be registered with them.
Absolutely non-negotiable. And the registration isn't just signing a form. Firms have to provide a lot of info.
Like what?
Oh, names of public clients, fees they get, their own quality control policies, lists of accountants involved, any legal or disciplinary stuff they're facing, even disagreements they've had with clients about accounting.
Wow, comprehensive. And they have to agree to cooperate with PCAOB investigations, too.
Yes, that's part of the deal. Consent to cooperate.
Okay, so SOX didn't just create the PCAOB, it also changed how the audits themselves are done. What were some key changes there?
Several big ones. Auditors now have to keep their work papers for 7 years. Criminal penalties if they don't.
7 years, okay.
Yeah, a longer paper trail. Also, every audit needs a second partner review, a concurring review, another set of senior eyes. And the audit report itself has to describe how they tested the company's internal controls.
That internal control testing seems like a major shift.
It was, and the PCAOB can enforce all this. They have teeth.
What kind of teeth? What happens if a firm violates the rules?
Well, penalties can range pretty widely. Suspending or revoking a firm's registration entirely, barring individuals from auditing public companies, limitations on activities, and significant fines. We're talking up to $15 million for firms for intentional screw-ups.
Oof. Serious consequences. Okay, let's shift to Title II. Auditor independence. This seems crucial.
It really is. It's all about preventing conflicts of interest. SOX banned auditors from providing certain non-audit services to their audit clients.
What kind of services?
Things like bookkeeping, designing or implementing financial IT systems, appraisal or valuation services, actuarial services, HR functions, internal audit outsourcing. Basically, services where the auditor might end up reviewing their own work or get too financially entangled.
Right, that makes sense. Can they still do tax work?
Generally, yes, tax services are permissible, but only if the company's audit committee pre-approves them specifically. Pre-approval is key for almost everything now.
And the relationships change too, right?
Yeah.
Partner rotation.
Yes, the lead audit partner and the reviewing partner have to rotate off that client engagement every 5 years. They need a timeout period before coming back.
5 years on, then a break.
Exactly. Other partners have a 7-year rotation. It forces fresh perspectives. Auditors also have to report a lot more to the audit committee. Now, critical accounting policies, alternative treatments discussed with management, any material written communications.
What about people moving between the audit firm and the client? Any restrictions there?
Oh, yes. There's a 1-year cooling off period. If someone was on the audit team, they can't take a key financial oversight role at the client like CFO or chief accounting officer within 1 year of leaving the audit.
So you can't just jump straight from auditing the company to running its finances.
Nope. And vice versa, the audit firm can't employ the client's CEO, CFO, controller, etc. in a role where they could influence the audit if that person worked for the client within the year before the audit started.
Got it. Lots of rules around relationships, financial ones too, I imagine, like owning stock.
Absolutely. Rules against direct or material indirect investments, certain loans, large bank balances, certain insurance products from the client. Also, restrictions on business relationships and contingent fees are a no-go.
Okay, let's move to Title III, corporate responsibility, shifting focus to the company itself.
Right. A huge part of this is empowering the audit committee of the board of directors. They are now directly responsible for appointing, compensating, and overseeing the external auditor.
So the auditor reports to the committee, not management?
Directly to the committee. The committee resolves disagreements between management and the auditor, and the committee members themselves must be independent. No consulting fees, not affiliated persons. They also need procedures for whistleblower complaints.
And then there's the big one, the CEO and CFO certifications.
Yes, Section 302. Top execs have to personally certify the financial reports. They're signing off that the reports are accurate, fairly presented, and that they're responsible for the company's internal controls.
What does that mean, responsible for internal controls?
They have to certify they designed them, evaluated their effectiveness within the last 90 days, and disclose any significant deficiencies, material weaknesses, or fraud to the auditors and the audit committee. No more, I didn't know.
And if there's a restatement due to misconduct?
The CEO and CFO might have to forfeit bonuses and profits they received, clawbacks. Plus, Title III makes it illegal for officers or directors to fraudulently influence the auditors.
Okay, Title IV, enhanced financial disclosures. More transparency.
Pretty much. Companies need to disclose material correcting adjustments found by auditors and those off-balance sheet arrangements everyone worried about after Enron. Pro forma financials have to reconcile with GAAP.
What else?
Ban on most personal loans to directors and officers. Faster disclosure of transactions involving management and principal stockholders, anyone owning over 10%.
And the famous Section 404.
Ah, yes, 404. Management has to issue an annual report assessing the effectiveness of their internal controls over financial reporting, and the external auditor has to attest to and report on management's assessment.
That's a big audit requirement.
Huge. Also under Title IV, companies need a code of ethics for senior financial officers, or explain why not, and they need to disclose if they have a financial expert on the audit committee.
Okay, Titles 8, 9X, and XC seem to be where the real teeth come in the penalties.
Definitely. Corporate and criminal fraud accountability. Big increases in criminal penalties. Altering or destroying documents relevant to an investigation. Up to 20 years.
Wow.
Failing to keep audit work papers for those 7 years. Up to 10 years. The statute of limitations for securities fraud was extended. Whistleblowers got legal protection against retaliation.
So real protection for speaking up.
Yes. And penalties for securities fraud itself went up to 25 years. Mail and wire fraud up to 20. CEOs and CFOs who knowingly certify false reports, fines up to $5 million and 20 years in prison. Willfully certifying, even higher potential fines.
Tampering with records, SEC powers. It sounds like a comprehensive crackdown.
It was intended to be. Tampering with records in official proceedings up to 20 years. The SEC got authority to temporarily freeze assets and to bar unfit individuals from serving as officers or directors of public companies. Retaliating against informants carries penalties too.
We also glance at GAO and DOL rules. Any quick thoughts there?
Well, the Government Accountability Office's GAGA standards, the Yellow Book, also stress independence, integrity, objectivity for government audits. The Department of Labor has its own independence rules for auditing employee benefit plans under ERISA, focusing on avoiding financial interests or connections that could impair objectivity. Different contexts, but that same core principle.
So pulling it all together, SOX and these related rules really represent a massive overhaul, wouldn't you say?
Yep.
Aimed squarely at restoring trust after those major scandals.
Absolutely. It created this interlocking system. You've got the independent PCAOB overseeing auditors, stricter independence rules for those auditors, much greater responsibility placed on corporate executives and audit committees, enhanced disclosures, and, crucially, severe penalties for fraud and noncompliance. It's a multi-layered approach.
It definitely sounds like it raised the stakes considerably for everyone involved in financial reporting.
It did. Which leads to a final thought for you, our listeners. Considering everything SOX put in place over 2 decades ago, how effective do you think these measures remain today? Are there new challenges to financial reporting integrity that maybe SOX didn't anticipate? And where should the focus be now? Something to ponder.